Today, I want to talk to you about loan consolidations. If you're reading this, you probably are wondering if this is a good time to consolidate your loans. You may also be speculating on how quickly you should contact a lender about consolidating your student loan or loans now that the Supreme Court ruled against the President's loan forgiveness plan and the COVID-19 student loan forbearance program is ending. There are times when consolidation is your best alternative. However, that is not always the case. Agreeing to a consolidation loan before you've done your homework is never a good idea. Why? If you are committed to paying back loan proceeds, you do not want to end up paying more money out over a longer period of time if you can possibly avoid it. A good rule of thumb to remember is that any time you extend payments into a longer term, you are also paying out more money in interest, often even with a smaller interest rate. For example, let's say that you're going to refinance your home mortgage. You have 15 years left on your 30-year mortgage. Your current interest rate is 9%. You discover you can refinance your current mortgage for 5.9%. To see why a lower interest rate may not be a good deal, read or watch this blog. You'll find the link in the YouTube description and the blog at my website. In this example, we will say that you also have these additional loans that you're considering consolidating. Loan number 1, credit card balance. $1,500 owed, $99 minimum monthly payment, 15.09 annual percentage rate. Number 2, a second credit card balance, $2,700 principal balance owed, $149 monthly minimum payment, and a 14.75 annual percentage rate. Number 3, a student loan, $7,800 balance owed, $209 monthly minimum payment, 4.45 annual percentage rate. Car loan, $18,000 balance owed, $250 monthly minimum payment, 6.16 annual percentage rate. It may seem good to lump all these debts together into your mortgage refinance loan, but why don't we take a closer look at this particular example? Using a loan calculator, we have calculated the length of time before each of these loans would be paid in full. Credit card number 1, 17 payments left, 1.4 years, $175 interest amount. Credit card 2, 21 payments left, 1.8 years remaining, $373 interest amount. Student loan, 41 payments left, 3.4 years, $611 interest amount. Car loan, 91 payments left, 7.6 years, $4,529 interest amount. Without changing a thing, you can clearly see that the example shows that all these smaller loans will be paid in far less than 15 years. Do you really want to stretch out these payments over 15 years? Yes, you will be paying interest. You already knew this. When you take out a loan, you will pay more interest each month in the beginning. Then, as you reduce the balance you owe, the interest portion of the payments gets smaller and more of the payment goes toward reducing the principal of your loan, which is the original amount you borrowed. In the case of these smaller loans, you've likely been paying on them for a while, meaning you are now paying less interest and more money is going toward the principal of these loans. Is it really going to make good sense to start over again? Something is going to happen when you wrap your smaller loan amounts into a home refinance loan. You are paying out more money in interest than you should. Your monthly payment will be higher over the entire 15 years because you have borrowed more money to cover these smaller loans. Nothing will be paid off until the whole loan is repaid. You could also think of it this way. Instead of being done paying these loans off in 1.4, 1.8, 3.4, and 7.6 years, respectively, you are paying on all of them for the whole 15 years. Is there something you could have done instead? Yes. You could pay off the first credit card balance in 1.4 years. Then take the amount that you used to pay that loan and add it to the second credit card balance. With that additional payment, you will pay down that second credit card balance at a faster rate because the whole additional amount is going to pay down the principal. With 2 credit card payments paid off, you are well on your way to knocking down that student loan quickly. What do you suppose happens when you take 3 monthly payments and add it to what you were paying for your car? Words can trick you sometimes, but you are smart. Don't be needlessly swayed into thinking that life will be so much better if you add your smaller loan payments into your refinance loan. Talk to your CPA or other financial professional to see what choice is best for you. Another thing to consider is that people mistakenly believe that they are free once their small loans are consolidated. What do you suppose happens next? Does it surprise you that many people start charging again like they have no credit card debt at all? Consolidation rarely, if ever, solves a person's overspending or misguided spending. Many times, consolidation gives people a false sense of security by masking the problem that caused these loans in the first place. Get out of the debt spiral. Pay your loans off as quickly as you can, and stay out of debt.